Good evening, participants. Welcome to Know Your Law Series 80 webinar on FEMA, background, ODI, and form fillings, being organized by Committee on Commercial Laws, Economic Advisory, and NPO Cooperative of ICAI. Today's faculty is CA Amar Guawala. He is a fellow member of the ICAI, having qualified in 2013 over 11 years of professional experience. He is also a partner at GK, DJ, and Associates, and uh, uh, also a part of team working on two publications for FEMA. Over to you, sir. Let's begin.
Thank you very much for your introduction, sir. Thank you, the Committee on Commercial Laws, Economic Advisory, and NPO Cooperative of ICI for giving me this opportunity. A very good evening to my colleagues and friends. So I'll just share my PPT. Yes. So the topics we will be discussing today is, we'll basically be discussing about Foreign Exchange Management Act. So we will look at the history of FEMA. It came from FERA, there was Foreign Exchange Regulation Act earlier. Then FEMA came in. Then we will also look at when we are giving consultancy, how do we start in this field? So we'll just have a small brief about it and what are the basic things we need to take care of, basic things we can deal with our existing clients, because even they might be requiring a lot of consultancy with regard to FEMA, and we might not be knowing that. So we'll talk a little bit about that. Then we'll move forward to ODI, the Overseas Direct Investments, and then the form filings. So first, the history. So in 1947, we as a country, India, we got our independence, and there was a need for an exchange control law. Now, exchange control already had been introduced by the Britishers, but as an act as in India, we established FERA 1947. Now, we all know the country was dealing with significant economic challenges, and there was a very important need to manage the foreign exchange reserves and to conserve it. Also, there was the World War II aftermath. The trade and the trade had been disrupted over the world. There was scarcity of foreign exchange, so there was a need of an exchange control act. The main aim, again, as I said, was to regulate the payment as well as to conserve the foreign exchange. See, when a country, every country will have to deal with foreign exchange. I mean, there are regular dealings with another countries for imports, for exports, even for loans. So there are regular dealings where you require foreign exchange, and as a country, you need to conserve foreign exchange. So that was the need. Then FERA 1947, if you say, it was less stringent and it was focused more on managing the foreign exchange to a regulatory framework rather than through strict enforcement. Over the years, as India also grew and the economic challenges also evolved, and there was a need to strengthen this act, and there was a need to make it more stringent, and there was a need to make it more comprehensive. Okay, so that was the introduction of FERA 1973. As FERA 1973 came into effect on 1st January 1974, it was mainly formulated to deal with this deep crunch of foreign exchange. Now, the main objective was to control, conserve, and regulate the foreign exchange. Now, ED was the main administrator for this law, and FERA introduced strict penalties, and the violations were regarded as criminal charges. There were a lot of mandatory RBI approvals. A lot of major transactions you have to do, you have to go to the RBI to get the approvals. Now, these days in FEMA, a lot of things has been shifted to the AD bank, and there's a limit over which you need to go to the RBI. So this FERA, because of this conservativeness of the act, it led to the India's economic isolation. While other countries were liberalizing the economy, see, the other countries, they came up after the World War, after the disruption of trade and the disruption of economy after the World War, the economy started opening up. Now, if you see other countries also, which other countries do have exchange control? If you look at maybe mostly European countries, or if you look at even USA, there are hardly any exchange control. They had exchange control. They had introduced exchange control earlier, but however, they have smoothly now removed these exchange controls. And that is what even India is going. It started with FERA. and now it is going towards it went towards FEMA, and it is regularizing it. It is making it more easy to do these foreign exchange transactions, and that we all know India opened up with globalization. So there was a need for privatization, liberalization, and globalization. That's how the India's economy was regained, and major part of this globalization also was helped by the introduction of FEMA. Now we just discussed the various reforms which took place in the year 1990s. So we just discussed about that. There was deregulation of the industrial sectors. Industrial licensing was abolished for almost all industries except 18 sensitive industries like alcohol, cigarettes, etc. And many industries which were reserved for public sector, they were now de-reserved. For example, only industries like railway, defense, atomic generation, they were reserved for the public sector. Then there were financial sector reforms. Now, to reduce the role of RBI, it reduced the role from RBI from regulator to facilitator for financial sector. And there was a very important step was a privatization of banks. RBI granted licenses to several private entities to set up banks, SDFC, ICICI, IDBI, UTI. These all came into existence. And with the entry of, see, now with the entry of these private banks, RBI had to strengthen its regulatory framework to ensure their financial stability, because now it was privatizing the banks, it was passing on the responsibility. So the regulatory framework had to be strengthened, and that's what FEMA took care of. A lot of capital adequacy norms also came up, and they were in line with the international best practices. We just look at the tax reforms also. There was a major change in the tax reforms also. Earlier, the corporate tax was very complicated, and then they've simplified it. There were earlier 11 slabs I've read, and now we know the slab rates now. Once the tax rate even went to 97.5%. So the tax rates have been simplified. Now, most importantly, the most important reform which we should be discussing is the foreign exchange reforms. And major part, a very important part was played by the introduction of FEMA. So the Foreign Exchange Management Act 1999 came into force with effect from 1st June 2000 by the notification GSR 371E dated 1/5/2000. Now, this FEMA replaced FERA of 1973. FEMA was more liberal and aimed at facilitating external trade and payments, which you can see in the current market. And it promoted orderly development and maintenance of foreign exchange market in India. RBI adopted a more proactive approach to manage India's foreign exchange reserves, which was critical in maintaining the economic stability of the country. Now, these reforms have led to a significant increase in the economic reserves over the period. See, every country has to maintain this foreign exchange reserves. Now, if you just go past, if you just look at if you just Google it out, if you see how the foreign exchange reserves have increased, you will see a great increase in the foreign exchange reserves held by the country. Now, why was FEMA required again? So, post-liberalization and the new industrial policy of 1991, there was a need to remove this regulatory and legal provision. There was a lot of, the foreign exchange transaction had to be eased out. It should be more easier in making foreign exchange transaction, and it should not be a headache. So that's what FEMA brought in. And it opened up India to the world. It also delegated legislation, as I said. RBI and central government were given powers. This change in the economic scenario led to the globalization of capital and also led to free trade across the globe. Now, the main aim was to manage the foreign exchange currency. And to do this, FEMA was required. So FEMA was introduced in 1999. Okay, and FEMA was a much liberal form of FERA, and it introduced concept of residentship in place of citizenship. So as FEMA, the main aim of FEMA was to develop clear policies and rules to control and develop the foreign exchange market, and it established a clear legal framework to manage these legal processes also. Now, if you see the forex exchange reserves from 1998 to 2004, there's a massive increase from USD 27 billion to USD 650 billion. It came up because of the ease in the process which FEMA has brought in. So India transited from an era of regulation, control, and prohibition to a new era of consolidation and management of forex reserves. We just look at a small differentiation between FERA and FEMA. So as I said, the FERA, the main objective was to control, conserve, and regulate the foreign exchange, while as FEMA, the main aim was to manage and facilitate foreign exchange. Now, FERA, foreign exchange, the main assumption for which FERA was that foreign exchange is a scarce resource, hence it must be protected and conserved. Whereas FEMA, the main assumption for formulation is that foreign exchange is an asset and that it must be properly managed. So that is one important thinking, which goes thinking and a strategy which is a big change in the FEMA. FERA, there were strict penalties, and any violation were criminal violations. Now with FEMA, the emphasis more on the compliance to be done, and penalties are civil penalties. As I said, violations were FERA in criminal offense and FEMA civil offense. FEMA was more restrictive in nature. Because it aimed at protecting the Indian economy, while FEMA is a more liberal approach because it encourages foreign investment and trade. Now, a lot of in FERA, there were a lot of requirement of licenses and approvals. As I said, a lot of time you have to run to the RBI for any transactions. While in FEMA, it has simplified a lot of procedures. There are very fewer restrictions, and it emphasizes more on reporting and compliance. FERA was more rigid, while FEMA is more flexible. The regulatory for FERA was central government, whereas FEMA it is RBI. And FERA had around 81 different sections and provisions, while FEMA has around 49 simple sections. Now let's see how FEMA helped economy and business. Now, if you see in the current environment also, there are a lot of businessmen who are bringing in FDI in the country. And there are also a lot of businessmen who are looking to invest outside the country. And we also have, in our practice also, we have seen a lot of our clients have now started to make foreign investments. So a businessman now, he wants to grow his business, and he wants to make his business global, and he's trying to do all this. When the business is geared up, we as chartered accountants also have to gear up with that. Now, because of this globalization, and because of the business being growing, obviously it's led to a lot of employment generation also. And as I said, FDI route has become a very important option for borrowing. See, a lot of companies, it is in my past experience also, I've seen a lot of companies earlier who used to borrow. Now, instead of borrowing, they've reduced on their borrowings, they reduced on the interest cost, and they've bought in FDI. See, FDI, I understand you have to give a percentage of your profits away, but that interest component and the repayments, so that you are free of that headache. So a lot of companies are now looking to a more FDI route compared to the borrowing route, which was more preferred earlier. And Indian entities, as I said, they're buying companies outside, they're making the brand more big and want to make a global image, and they're even competing with the global market. Now, I've just taken some reference out of the Economic Times. India's foreign exchange reserves rose to an all-time high of 648.7 billion as of 17th May 2024, and it's covering around 11.4 months of imports and strengthens the buffers against the payments which have to be made. See, foreign exchange reserves are what each country, as I said, they have a lot of transactions are being done between countries, and there may be imports which have been done, and liabilities which have to be paid. So you have reserves enough to cover the liabilities which you have to pay, and that India has strengthened a lot in the past, and that is because the environment which has been inculcated by the FEMA. Now, as the business is growing, we as chartered accountants also have a lot of opportunity in this field. First of all, to make a mark in this field, and also to help our fellow businessmen. For example, now if for example I'm a statutory auditor of a client. Now this client wishes to make an overseas direct investment. He wishes to make an ODI. He wishes to make a subsidiary in a foreign country. He will not be able to do it unless he gets a certificate from his statutory auditor that all the rules, regulations of ODI have been complied with. Now, there are two choices for the statutory auditor. One, he can say, okay, I'm not in the FEMA practice and I won't be doing it. In that case, the company will have to change the statutory auditor. And suppose the CA says, okay, I'll do the certification, but he will not be able to sign this certificate. He will not be able to provide the certificate unless he understands the whole laws and provisions of ODI. Because if you see, we'll be seeing this certificate later on in the next slides. You need to know the rules and regulations associated with making that ODI, and you have to certify whether all the rules and regulations and directions have been followed by the company. So you need to be well prepared before you provide this certification work. So we have to gear up for that. And as I said, a lot of businessmen are bringing FDI, they are making ODI. So there's a very untapped market potential. There, see, when a businessman also, when he also says, okay, there is some FEMA related work, he also looks at, okay, I need to have a proper, strong chartered accountant who can handle this work for me. So there are very few consultants in the market right now, and it is our chance to make a mark over there. There's a huge demand for professionals as the business is growing. Further, as we know, in FEMA, ED is also involved, and no one wants to get on the wrong side of ED or RBI. So you want all the businessmen also want the compliances to be done perfectly, and that there should not be any shortcomings in the transaction which they have done. So they also look out for professionals who can handle this professionally and without they facing a problem in the future. So that's why we have to gear up then, because business today are being globalized. They are looking for chartered accountants, and then we have to gear up for the same. Now, the question is, how do we start the FEMA consultancy? But we should look. First, my understanding is, first we should look at our existing clientele. In our existing clientele, also there might be a lot of clients who might be requiring FEMA consultancy, or who might have already violated FEMA. So we have to look into our own client base, whether any FEMA violations have been done, or whether they are in need for any FEMA regulations. So that is, we need to see. Now, for example, how to see? First of all, the definition of a non-resident Indian. Now normally we'll be doing a lot of individual returns for our clients. Now there'll be a lot of individual. Now this client, suppose, wishes to now travel to maybe take up a job in a foreign country, and he might become non-resident for as per FEMA. So we need to advise him what all changes he needs to do. For example, he needs to change his whole bank accounts. He needs to, once he becomes an NRI, he has to have his NRE, NRO bank accounts. He cannot have the resident savings account. So we need to advise him accordingly. For example, and vice versa, if there's an NRI client, there's an NRI client, and he's staying abroad. Now he comes back to India. So what all changes does he need to do? So we need to advise these clients. Further, even if NRI clients, they might be having a lot of properties in India. They might be collecting rents. They might be transacting in property. So we need to guide them on what all requirements they have to do to maybe buy property, to sell property. What are the requirements, so that we can give consideration on the same. Then also, suppose I am a statutory auditor of a corporate or any entity, and now this entity has done an export sale. Now, as per FEMA, there is a time limit within which the collection has to be there. According to me, it is 9 months. So he has to get the collection of the export within 9 months. Otherwise, you need to apply to the AD bank and ask for an extension. So and a lot of time we go to an audit, we see, okay, the client has done an export sale, and he's not received the money within from 2 years, and he's written off the same as bad debts. No, that is a FEMA violation over there also, because to write off a debtor of an export sale, there are certain conditions which have to be followed, and maybe approvals of the AD bank might be required. Excuse me. So this is where we can help them. Then if we have NRI clients, they will be making some gifts to their relatives. They may be making payments to the children's, or payment to the children or relatives who are abroad for studying. Also, we can guide them regarding the liberalized remittance schemes, and we can also guide them regarding the $1 million scheme. As we all know, liberalized remittance scheme is available for the resident individuals, while as $1 million scheme is for the non-residents. So any resident, they can if you're looking for current account transaction, they can only remit up to the 25 lakh, 2,50,000 USD per year. So that is under the liberalized remittance scheme, 2,50,000 USD per year. While a non-resident Indian can remit up to $1 million per year, per financial year. Sorry. So we can guide them in respect to that same concept. We can also guide them regarding the capital account transaction, current account transaction, what is permitted and what is not permitted. So If regard to opportunities, again, there is also a lot of form filing which we have to do. If a businessman is doing a transaction, suppose he's doing an ODI, he's getting, or suppose he's getting FDI, there's form filing which is required. Because ODI forms have to be filed, form FC will have to be filed. If FDI, he's getting FDI, form FCGPR might be have to be filed. Sorry, form FCTRs may have to be filed. So there are a lot of opportunities over there. Further, once he has entered into foreign exchange transactions, there are annual returns also which have to be filed. For example, there's a form APR, there's a form FLA. So these all forms will have to be filed. We'll discuss in detail when we come to the form section, but that is where we can come helpful to the client. Now we can also help them in implementation in transaction. A lot of time a client comes to us, okay, they wish they need to transfer the shares of a resident company to a non-resident, and then FCTR has to be done. So sometimes the non-resident also puts the onus on the, see, the responsibility is of the responsibility of filing the form FCTR is of the transferor or transferee who is the resident in India. So the non-resident will obviously put an onus on the resident company to get this transaction done. So they mostly approach the chartered company. Okay, you will need to discuss with the non-resident company also what are requirement you want from them, what are documentation you want from them, and you get the documentation done. So we can also help them implement, get this documentation done, get the valuations done, and implement and execute the transactions. And suppose if the company has the, or the entity has done some violation, so who better than a chartered accountant to help in compounding or representation before the RBI? So we have always been good at representing across various forums. So in RBI also we can take up the representation matter point. So just a small brief to how to, when we take up FEMA work, what we should ensure. See, first of all, the timelines. When we are committing to the client regarding timelines, we have to take a lot of things into consideration. We also have to take into consideration the timelines for documentation. Suppose if you have to get the documentation work from the non-resident also, there is a time difference also, so you have to take that into consideration. Plus, there is a lot of online filing which is required, which also there may be some technical problems you may face, so you have to keep that also in mind. And one more important thing, whenever any form you are filing, suppose if you're doing any transaction, you're doing an ODI transaction, you're doing an FCTI transaction, you're doing an FCGPI transaction, any transaction you do, you should always send the drafts to your AD bank before making the transactions, and the AD bank should also be fully made aware of the transaction, and it should be transparent. You should always consult the business bank. You have to be transparent to the AD bank. Tell him about the whole transaction. Send him the drafts of the documents. So at least if there is any suggestions or any changes, he can guide you on the same, and then you can file the forms, because mostly all these forms will be approved by the AD bank. So AD bank is only going to approve it. So it's better, you should just get it vetted from him, from the AD bank earlier. So we should always have a checklist also of the documents which we require for doing any transactions. So these all, any approvals which we require, any online form which have to be filed. So this all has to be there. Now, how to master this subject? To study the law, of course. But how do we do that? So is now one big important thing which I feared while starting FEMA is, how do I know what is the final law? Because see, we have been doing Income Tax Act, we've been doing Companies Act since a long time. We just take we have we have the book which we have the act which gets updated each year, and we get the updated act in our office. And whenever we want to refer to a section, we just open the book, we just open the act, and we go to the page of the section, and we read out the law, we read out the section. But in FEMA, how do we go about it? How we go about the rules, regulations, and directions? So that was a challenge for me, and so I'll just share my experience on that. But maybe just in the next slide, I've put through, okay, how do we do it? We'll discuss it accordingly. And help of ICI. ICI is conducting a lot of seminars, a lot of certificate courses have been done. ICI is helping us. It's taken a great, tremendous efforts in helping us in understanding this law. Especially the Committee on Commercial Laws, Economic Advisory, and NPO Cooperative of ICI. The seminar has been organized by them. Also, a certificate course also had been organized. So the ICI has taken a great initiative to educate us about the allied acts other than Income Tax Act and Companies Act, and we are very thankful to ICI for that. Also, a lot of FEMA ready reckoners are coming up. So in FEMA, I understand that there are two ready reckoners which have been come up by ICI. So that's also there. And networking. We all have to network, and we as a chartered accountant, we have to network and help each other in the difficulty or in understanding the law. So these are the broad contents of the Act. Section 2 is basically the definitions. Section 3 to 9 is basically where the important things are for us regarding the regulation and management of foreign exchange, dealing in foreign exchange, holding of foreign exchange, current account transactions, capital account transactions, export of goods and services, realization and repatriation of foreign exchange. So these are the main sections for our reference. Then section 2C and 10 to 12 is basically the authorized dealer related. 13 to 15 is basically for contravention and penalties. 16 to 35 is adjudication appeals. 36, 38 is enforcement directorate. 30 and 14 is business provisions. So I just go to basic framework of FEMA. So Foreign Exchange 1999 passed by the Parliament. Now the foreign exchange management, the reg. See, now there are three things when we look at FEMA. There are normally three things we normally study. One is the rules, one is the regulations, and one is the directions. So these regulations are basically notified by the RBI, and it gives the RBI the power to make regulations by notifications. Now, these regulations are instruments by which power to make substantive law is exercised. So, regulations become a very important part. Then there's foreign exchange management rules. Now, this is notified by the central government and it authorizes and gives power to the central government to make rules. Now, rules are what? Rules are instruments which give the power to make law about the procedure. So, rules take care of the procedure, regulations take care of the substantive law that the regulation take care. So basically, when we're going for FEMA, according to me, even if we read the latest rules, the latest regulation and latest direction, we should be in a good track. As we saw, regulations are a much wider scope compared to the rules because rules are basically for the procedure. Okay, and yes, then there are master directions. Now, these master directions are issued by the RBI to the AD banks. Now, that is, see, though it is applicable to the AD banks, it is very important for us also because Indian AD bank is going to act accordingly. So, our documentation or whatever procedure has been mentioned in directions, we should follow that. Then the master circulars. Circular is nothing but just consolidation of the existing guidelines or instructions in a particular subject by the RBI. Then there are press notes. See, in FEMA, there's also a Department of Promotion of Industry and Internal Trade. If you, we'll also discuss it later. When you're doing a direct investment, if you're doing a step down investment, so over there you also have to intimate to the Department of Promotion of Industry and Internal Trade. So that also a filing is required. So they also regulate a lot of policies and procedures aspect of the law. So we should also look at the press notes issued by them. And RBI also issues a lot of FAQs. Now these normally, if I've seen, it helps us solve a lot of our questions. So a lot of RBI FAQs it all can be downloaded from the RBI website, and we should look at them. So now, how to read the law? So we just take 10 minutes and we'll go to the RBI portal and we just search for the latest directions, latest rules and regulations. We'll just see how do we go about that. Now, my now what I have experienced it. If you search for the master directions, it will give you the link to the latest rules and regulations. So always when you go to the RBI portal, search for the latest master directions. It will itself give you the link to the rules and regulations. So now there are two options. One, our very own Google, or secondly, we can go to the RBI portal and we can check it out. So we just go to the RBI portal and just check it out. Okay. And there's if you could put the search words properly, it's easy to find out. So suppose if we just try to look at FDI and we try to look at ODI. Okay, so I've gone over here and you can see my screen. Okay, yeah. So we go to research. There is notifications. Yeah, notifications. I'll just type foreign investment in India. So when I type to the foreign investment in India, there's an option when you can use with the exact phrase, and I'll just update the result. Okay. See, there is a foreign investment in India notification, but now that is basically regarding the rationalization of reporting in single forms and regarding the forms portal. We are not looking at that. We want to look at the law, which is the foreign investment in India. So just go more further. Again, there's a reporting in single master form. Yeah, we just go to the, now there's a master direction, which foreign investment in India. So I'll just open this tab. So as you see, there's a master direction for foreign investment in India. And though it is of 1718, it is updated up to August 8, 2024. So this works for us. Now let's go at the rules and regulations. So if you just go, there are a lot of links over here. So if you just go over here, so if you see, these are the rules. If you just right click over here and I can just enter the rules, and the rules also, so we can just go to that is the latest rules, and it is updated up to 2020. No, it is updated up to 2024. Amended up to 23 April 2024. So these are the latest rules regarding the FDI. And there will be regulations also over here. Yeah. If you see, there's a regulations over here. So if I just go over here, the latest regulation, again, it is amended up to April 23, 2024. So we have the latest directions, we have the latest rules, and we have the latest regulations for FDI. Okay. Now we just search for ODI. What is that phrase I said? Overseas investment. Again, with the exact phrase, I just go for update result. Now there's a master direction, overseas investment 2024. So I'll just click the link. So there's a master direction on 2024. Okay. And if I want to see the, again, if you see the rules, the rules are over here and the regulations over here. If I just go click on the rules. So these are the latest rules which have come in. And if I go at the regulations, here are the regulations. So this is the list of regulations. And so we can just, if we download, we can always download it from the portal. And I think if you have the latest directions, you have the latest rules, you have the latest regulation, I think you should be good to go. So I just, okay. So I'll just return back to the PPT slide. So that was the way. So basically, you just have to go to the RBI portal, and RBI portal is a one-stop library for FEMA. Anything you require, you will get it at the portal. Now we just in a small brief, we just run through a little bit aspects of FEMA, which we can help us in a day-to-day consultancy, and then we'll go over to the ODI and form filing. We won't take a lot of time over here. So basically, just if again, if you see the definition of person resident in India, uh, a person resident in India who means a person who has resided in India for more than 1 to 2 days during the previous financial year, but does not include a person who has gone out of India or who stays outside India in either case for taking up employment outside India. For example, I just give you a small brief. For example, when you want to check whether a person is a resident in India or not, the criteria is of 1 to 2 days. He should be present in India for 1 to 2 days. However, there are some exceptions. For example, if a person though he has stayed more than 1 to 2 days in India in the previous year, but he has left the country in that financial year. He has left the country, and he has left the country to take up an employment out somewhere in a foreign country, or he's started a business outside, or he's gone outside India without any intention of returning back. Then he will not be considered as a resident, though he has stayed in India for more than 1 to 2 days, but his intent, he has left the country in that financial year, and his intent is not to come back, so he will not be considered as a resident. And vice versa also. Suppose a person who has stayed with less than 1 to 2 days in the previous year, but who has come back to India and he's taken up employment in India, or he started a business in India, or he has come to India and now there's no intention of returning back, so he will be considered as a resident. So if you see, intention plays a big important role. So, as we know, the definition of resident is also in Income Tax Act. But in FEMA, what as I understand, it is more about the intention of stay, whereas income tax emphasis on the actual duration of stay. One more difference on the income tax, that resident has to stay 1 to 2 days or more to become a resident in India. In contrast, FEMA individual has to stay more than 1 to 2 days. 1 to 2 days, more than 1 to 2 days. Other than the exceptions, so exceptions is a different thing. Now, we discussed earlier also, what are the obligations of a person who is going abroad for job or business? So, if it's as a person who's a resident of India, now he has he's traveled outside. Now he has taken up a job over there. He's become a non-resident. So what all things he need to do? He needs to change his bank account. He needs to check his bank account to NRE, NRO accounts. He cannot use a resident savings account. He should intimate the companies where he's a shareholder, because now in the company, when they're shareholding, they'll have to show as a non-resident. So you'll have to intimate them. There are a lot of other agencies also where he'll have to give the intimation. For example, any mutual fund accounts he's holding, so he'll have to pass on the information over there. And vice versa, when he's coming back to India, also the change in bank accounts will have to be required to be done. Then we have to tell him that now he does not have the option of $1 million scheme, and he'll have to go into the liberalized remittance scheme. Only 250,000 USD he'll be able to remit outside India. So we'll have to consult him on that basis. NRO, NRE accounts we'll have to consult him on. One basic, I'm not going technically into the accounts. Just give you a basic. See, NRE account is basically is a freely repatriable account, and there are no restrictions or approvals required for removing removing the amount out of the NRE account. Whereas from NRO account, you require the restriction, the form filing restrictions are all applied to the NRO account. Okay. See, NRE account, though the account is physically in India, is technically outside India. Whereas NRO account is physically as well as technically in India. My senior sir always gives an example. For example, suppose if you're going for a holiday, you're visiting some country. It's Christmas now, so a lot of people might be going there. And once you have cleared the immigration, so though you are in the land of India, you are technically outside India. So that is NRE account. So before your immigration, your NRO account. After immigration, you're in an NRE account. So there's a difference if you want to understand. As we said, we got to export of goods and sales also. We should consult the clients. There is a time limit within which the proceeds has to be got back in. Any amount of write-off also has to be done as per the guidance and as per the rules and regulations and as per the terms and conditions. To just go a little fast, the PPT is available. So we'll go into now. We start the overseas. We'll discuss about the overseas direct investment. Now, if anyone wishes to learn about ODI, it is much more easier because it is a very updated part of the FEMA. For example, why I'm saying this? Because the latest rules, the latest regulation, and latest directions have come in 2022. Of course, the directions of 2022 also have been amended, and now the directions 2024 has come in. We just saw. But except for direction, the rules and regulations are of 2022. So these are the latest. You just need to you don't need to go a lot back with regard to the ODI rules and regulations. You don't need to go search back what are the later amendments. So if you read the rules and regulations of 2022 and maybe the directions of 2024, you should be well versed with the ODI rules and regulations and how to go about them. So now we just discuss what are the major changes which these rules regulation of 2022 has gotten compared to the earlier. Now the definition of foreign entity has changed. For earlier, joint venture and wholly owned subsidiary had been defined. Now they have replaced this with foreign entity, with the word foreign entity. Now what is a foreign entity? Foreign entity means any entity formed or registered or incorporated outside India. So any entity which is formed or registered incorporated is a foreign entity, and they have discussing about any invest or ODI which are doing in a foreign entity. Now this includes foreign entity. It includes LLPs also, and registration is not compulsory. Now, what is the definition of Indian entity? Indian entity includes companies, body corporates, LLPs, and even partnership firms registered under the Indian Partnership Act 1932 are covered. Any Indian entity. See, our question is who all can make a ODI? Even the resident individual can make an ODI with respect to some terms and conditions. But even earlier, we were under mindset that only companies can make an ODI. But no, LLPs can also do it, and even partnership firms can also do it. The rules and regulations, we just discuss about it in due course. Now, one major change was earlier an Indian entity who was not engaged in financial service activity in India could not make an ODI in an entity engaged in financial service activity abroad. So now any Indian entity who is not engaged in financial service activity can take an ODI in a foreign entity engaged in financial service activity, except for banking and insurance, provided certain conditions are met. See, if you see what is the financial service activity, except banking, insurance, there's a lot of wealth management services, so those also get covered over there. Now, financial service activity has been defined as an activity which, if carried out by an entity, requires registration or is regulated by a financial service regulator in India. That is RBI. So, if you also want to look key, what is when I'm doing an ODI, that company whether is it engaged in financial service activity or not. So, how to go about it? Whether if it was doing this activity in India, whether it would require registration or whether it would be regulated by RBI. If yes, then it is engaged in financial service activity. A definition of control has gone a big change, and this becomes crucial when you are making the ODI. Also, crucial when we are doing an APR also, as we will discuss about it. Now, control. See, we all know normally if you want to ask you, a company has control over another company. So our understanding as per the Companies Act is, first of all, if he has 51% or more shares in that other company, that is what we understand by Companies Act. Or if he has the right to appoint majority of directors, or if he has the right, if he can control the management or policy decisions. So these are the two three ways when we say ki Indian company is exercising control over another as per the Companies Act. Now, over here, very important to note key this percentage. Now, over here, they've said 10%. So we just read it out. Control means the right to appoint majority of the directors or to control management or policy decisions accessible by a person or person acting individually or in concert, directly or indirectly, including by virtue of the shareholding or management rights or shareholders agreements or voters agreement that entitle them to 10% or more voting right in another manner entity. So if an Indian entity holds 10% or more in another entity, control gets exercised. Okay. Now, very important because you may become a subsidiary. Up 10% के ऊपर control है, you might be got the definition of subsidiary. So it is very important to understand this control. Now 10% is also control. Also, when we're doing an APR, we just discussed. I just giving a small brief. When you're doing an annual performance report, which needs to be suppose a company has done an ODI, he has to file an APR every year. It's an annual performance report to that ODI is present, and though now the requirement is if the company exercises control over the other company, that other company's audited financial statements are compulsory required to be submitted in India. Now we had a case where there was a client and he had made an ODI in a foreign company. He had made a company in US, and that the shareholding was more than 10%. However, audit was not applicable to that company, and there was not unaudited financials used to come. But the bank insisted, as per the provisions, if there's 10% or more holding, so he has to get his accounts audited, and he has to submit it to the Indian company, and which has to be submitted to the AD bank. So that is very important when you're doing an APR. Now, one important control is now the definition is subsidiary or step down subsidiary of a foreign entity means an entity in which the foreign entity has control. See, now control is 10% or more. So it becomes very crucial over here. So a subsidiary or step down subsidiary of a foreign entity means an entity in which foreign entity has control. Now, here there is a restriction that foreign entity should not invest in India through more than 2 layers of subsidiaries. So now this 10% criteria might become important because sometimes we see, okay, subsidy is 50% के ऊपर. So if it is less than 50%, we can say, okay, it's not a subsidiary. Normally, when you're going for when we're seeing multiple layers, so we see subsidiary, but over here you have to see 10% also might become control, and 10% will also become a subsidiary. So you have to take a note of that. Now, ODI in ODI, the definition of net worth plays a very key role. For example, the main criteria of making an ODI remittance is you cannot make it more than 400% of your net worth of the company, as on the last audited financial statement. We'll discuss about it more in detail, but we just look at now the definition of net worth. So, definition of net worth earlier included only paid up capital and free reserves. But now net worth will have the same meaning as per the Companies Act, as per the Section 2 of the Companies Act. Hence, if you see, it also will include the security premium account. So it increases the chances of the more limit also it increases of giving your ODI, because now in net worth while calculating the net worth for calculating this 400%, you also have to include the security premium. You can also include a security premium account as per the as per the section 2 of the Company Act. It's also included in it. However, we all know it still does not include reserves which are created out of revaluation of assets or any write back of depreciation or amalgamation. So that is also not included in Companies Act. We not included under the net worth definition, and it won't be included for FEMA also. Now, the question is, when we're saying an entity cannot make 400% of 400%, cannot make an ODI more than 400% of its net worth, how can an LLP and partnership firm make? So, for an LLP and partnership firm, the net worth should be the sum of the capital contribution of the partners and the undistributed profit of the partners. So, basically, capital and current account. So, that becomes your net worth for an LLP and for partnership firm. Of course, over here also you don't have to should not take into consideration a deferred expenditure or any miscellaneous expenditure which can be written off. So the major modes of financial commitment in ODI, what normally a lot of businessmen do is first investment in equity share capital of a foreign entity, or investment in debt instruments, giving a loan to a foreign entity who is a subsidiary, or giving a financial commitment, maybe by way of guarantee. A lot of time what happens is an Indian entity acquires a subsidiary in a acquires a foreign company. This foreign company earlier had a bank loan. Now this foreign once there's a shareholding change of the foreign entity, the bank will also ask that the promoter of your holding company should give a guarantee. That also may be required. So that also comes under the gambit of ODI. So maybe the holding company may give a guarantee, or even the promoter can give a guarantee. So we'll discuss about it more in detail. So first of all, we discuss the quantum of investment. As I said, we can any remittance for ODI, remittance or even a guarantee, remittance by way of equity capital, remittance by way of loan, or even guarantee. The accumulation, it cannot exceed up to 400% of the net worth as per the latest audited financial statements, not exceeding 18 months. Now, though there is a one condition, if the foreign commitment in a financial year is exceeding $1 million USD, then approval of RBI is required, even though that financial commitment of the Indian entity is within the eligible limit. Suppose the company has a huge net worth and the ODI is being made of more than 1 million. Now, the cumulative ODI is now exceeding $1 million USD, and though that 400% is not there's still a limit within the 400% of the net worth, still the approval will be required. Yeah. Now, however, this limit of 400% does not apply if this investment is made out of balances held by the company in its exchange earners foreign currency account, or out of any funds which is raised to the American depository receipts or the global depository receipts. So basically, if a company has earned some foreign currency outside India, and if he has a foreign currency account outside India, he has this exchange earners foreign currency account, he can make a transaction from there, and that 400% will not apply for that. Other rules and regulations will apply, but the 400% limit will not apply. Earlier, there was the concept of utilizing the net worth of the subsidiary or the holding company by the Indian entity. Now, this has been discontinued with it. There's like a group entity, there's a company, I can use the first, they could use the net worth of the subsidiary holding company, and now that has been discontinued. So basically, any entity which wishes to make an ODI can only do so up to 400% of its net worth of the latest audited financial statements. Now, it throws a lot of Pandora's of question. One should start doing it practically. A lot of questions, a lot of cases come up. For example, a company might be preparing a balance sheet in Indies, and another company might be preparing a balance sheet in accounting standard. Now, net worth might be different as per Indies, net worth may be different as per companies, as per the accounting standard. Now, I give an example. A company has issued redeemable preference shares. Now, when we're talking about redeemable preference shares, for a normal accounting standard balance sheet, it is a liability, and we will show it under, sorry, for a normal accounting standard balance sheet, it is a capital, and we'll be showing under preference share capital in a normal accounting standard balance sheet. But whereas for an India's financials, it will be a liability. We'll be bifurcating between liability and equity, and basically that redeemable portion, if it's a convertible, then the redeemable portion will be on the liability side. If it's fully redeemable, it is on a liability portion. So now, net worth as per the accounting standard is different, net worth as per Indies is different. Now, which to take? So, as per my understanding, the law says it has to be done, the net worth of as per your latest audited financial statement has to be considered. So, if your company is for your company, Ind AS is applicable, or you've already taken voluntary Ind AS and your balance sheet has been prepared in Ind AS, you should go as per the net worth of Ind AS. Or if your company for which Ind AS is not applicable and you are doing it as per accounting standard and your last audited balance sheet is as per the accounting standard, you should go as per the net worth as per accounting standard. So basically net worth as per your latest audited financial statement you have to take, whether it's Ind AS or whether it is accounting standard, whichever is applicable to you. Now, now when we say कि last audited financial statements, so suppose suppose for example we are in the month of May 2024. So now if we all know for the financial year 2023-24, the due date for filing your balance sheet with the ROC is by September 2024. So there may be a chance that by May 2024 the financials are not yet ready. So but I want to make an ODI. So which balance sheet should I refer to? Because I do not have a March 24 balance sheet right now. So it says your latest audited financial statements not exceeding 18 months. So I can refer my balance sheet as on March 2023, the audited balance sheet as on March 23, the net worth. Accordingly, I can do the ODI. I can calculate the 400% with respect to the net worth as per my March 2023 financials. But this is valid only up to October. So 30th September. Once you are in October, you have to go now. For the due date has passed for preparing a balance sheet. So if you're doing the ODI in the month of October 2024, you have to have your net worth taken from your March 24 balance sheet, and it cannot be from a March 23 because now the due date has passed for the preparation balance sheet, and now March 24 balance sheet should be available, and it should be done from the March 24 financials, the ODI for the calculation of the 400%. Now whether only a statutory audit balance sheet audit required, whether special purpose is allowed, according to me, yes. We've also taken an opinion and we've understood we've also done it in some cases, and the AD Bank was also given us has said a yes for that, and a special purpose audited balance sheet can be done, and ODI can be done as per the net worth of the special purpose audited financial statement. See, special purpose, everything remains the same. You are getting an audit done, but it is not under the statutory. It is not under the Companies Act. We normally do the financial audit for the whole 2020 for the whole financial year as per the Companies Act. Now there's a special requirement. We're preparing a financial statement. The audit report will be there, and the audit will be done as per the or per all the guidance of the ICI and all as per all the auditing standards, and a special audit on as per the net worth of the special audit purpose audited financial statements. You can calculate the 400% of net worth. Sometimes it happens. There's a new incorporated company. A newly incorporated company might not have a previous year net worth, but he wishes to make an ODI, and he has a lot of share capital. See, net worth, normally share capital can also play a big role. So he has a lot of share capital, and he can hence he has a good amount of net worth. So he can make, and he wishes to do this ODI. So he can get a special purpose audit done, and accordingly, with respect to that, he can calculate the 400% and do the ODI. Now, what happens is, suppose in the above example, we were in May 2024, and we have done the ODI. Okay, we have done the ODI as per the financials of 22-23 because the financials of 24 were not yet prepared. Now it is now in September. Once your financials of balance sheet is prepared, balance sheet is signed, you see that the net worth has reduced. Now, but you have, and if you again try to see the ODI which you have done, and that is now coming below that 400% limit. Now, what to do? You don't have to do anything. When you are making your own ODI, that time you have to see whether you are not exceeding the 400% of the net worth as per the latest audit financial statements. Afterwards, there may be a loss. The net worth may reduce. You don't have to get back the investment. There is no condition regarding that. So what all documents you require while doing an ODI transaction? First is a Form FC, which is, I think, the full form should be a Form Financial Commitment, and this has to be duly filled and signed by the management. Once you're doing your first ODI, when you will submit your Form FC, a UIN, a unique identification number, will be generated for that foreign entity. So when you're making another ODI in that same foreign entity, you have to give that UIN. So any further ODIs in that foreign entity, you have to quote that unique identification number which you got when you're doing the first investment. A statutory auditor certificate, as we discussed earlier, no company can do, no entity can do an ODI without the certificate from his statutory auditor, whether with regard to all the FEMA compliance have been complied with. Now there is a pre-format. There's a format which is also available at the RBI portal. We'll also be discussing it later, and there are the various questions which been asked. We have to answer accordingly, and we have to say if it is a loan-based transaction, we have to say answer regarding the loan-based transaction. If it is regarding equity, we have to answer regarding that. So we'll discuss later. And board resolution is required. You're making an ODI. A board resolution of the company is required that he wishes to make this ODI. This ODI is done. Loan is being given because board resolution. You'll also get to know what is the value per share you are investing in. Again, a valuation report is a must. As per the ODI. Now, what is the value at which you can do this investment? If you're doing an investment in equity shares, then what valuation should be done? As per the law, it should be as per the fair value as per the internationally accepted methodologies. So, in internationally accepted methodology, normally you take into normally DCF, discounting factor method, is one of the most commonly used method. No, you can also use your net worth method, where of course you should. The investments or your any property should be got at the stamp duty value. Or you can also do a comparable market method. So these are the following methods which are available: DCF method, net worth method, and your comparable market method. So which is more suitable you can use. So basically, what the law says, it should be at the fair value. It should be a fair value as got by the internationally accepted methods for this particular transaction. Now, the underlying document, the underlying document is a must, because that document is a basis. Whether you are making a loan, you are making a guarantee, you are giving an investment, you need to have the supporting underlying document. For example, if you're investing in equity shares, you should have the share transfer agreement. The SPA is a must. The auditor should also go through the share purchase agreement. There might be a lot of details, there might be a lot of commitments, there might be a lot of conditions might be there in the document. So you should always go through the document. Then if you're giving a loan, when we'll be discussing later also, a loan also, the interest also has to be charged, and again that also has to be at the arm's length price, as per the arm's length price which is existing in the relevant foreign country. For example, suppose if an Indian company is giving a loan to a company in Japan, the Japan interest rates might be quite less. Might vary from India. I think they're quite less compared to India. So you cannot, if you say arm's length price India के हिसाब से होना चाहिए, तो it will not be possible. It will not be feasible. So it has to be the arm's length which is existing in that country. So you have to go through the loan agreement, whether the interest has been prescribed, whether it is prescribed, it should be at arm's length price, what the rate they have prescribed. So you should go through the document. If you're giving a guarantee, whether it is an open-ended guarantee, what is the time period, even for the loan, what is the time period? You should always the document, it should be scrutinized in thorough by the chartered accountant also. Again, sometimes banks also ask for an undertaking by the company, by the Indian entity, saying that you state that all the FEMA compliances have been complied with. So that undertaking that Indian company might have to give. Now, FATF compliances. What is the full form of FATF? Is Financial Action Task Force. Now, we shall be discussing more in detail. It's an organization which makes a recording, or which regulates which country is more suitable for investment, or where there should be a restriction for investment. For example, if they suspect a country is that there's no lot of in the country, there's a lot of transparency is not there, or it is or there is or it thinks it is engaged in terrorist activities, or it engages in some various violations. So there may be FATF might have some restrictions for making investments in those countries. So this FATF compliance we have to check. While if an Indian entity is making an ODI, we should check whether the ODI he is doing, whether the country is not covered under restrictive list in the FATF compliance. Now, if how to see it? on Google, just type FATF, Financial Action Task Force. You will get the website. On the website, if you just search through it, you will find the list of the restrictive the entities they're restricting, and they submit these online reports regularly. So you should see what is the latest submission they have, and you should always download it and keep it in your file. See, your audit documentation has to be thorough. If you're a chartered accountant, and if you're certifying that statutory auditor certificate, so your documentation has to be as per the auditing standards. You should keep a record of the date on which you have generated this FATF, downloaded this FATF from online, and you should save it. Also, sometimes when you're doing an ODI, it may take time. Suppose you've started today, it has taken maybe a month for the ODI transaction to happen. So just before signing the certificate, just before sending the remitting money, you should again go and check the FATF compliance, because there may be a change. So you should always go through that. Form A2, we all know कि whenever we are whenever any entity or whenever any Indian is remitting money abroad, it is a declaration which we have to give to the bank to instruct him to transfer the money abroad. So that a bank will do. That is that we do not have to do as a certification. We do not have to look into that. But that's what the company will have to do. Suppose if we are also preparing all the documents for them, then we might have to prepare the form A2 and give to them. So we just discuss the forms first. So first, as I said, the form FC, ODI forms is the form FC, form financial commitment. Now it has various, it has a part. See now, if you see the form FC, there will be various parts, parts 1, part 2, part 3. Part 1 is basically the financial commitment form. This is a form which you have to fill. The management will sign it. Form ODI has to be submitted offline. It is not to be filed online. It has to be submitted in offline to the AD bank. Okay, with all the documentation. All the documentation you have to. The documentation has to be, the file has to be prepared. It has to be submitted to the AD bank offline. Okay. Now, Form FC part 1 is where when you're making this ODI, this Form FC part 1 comes in. Then part 2, part 3, one is for APR, one is for disinvestment. So we'll discuss about it. Okay. Now, in form for this Form FC, there are different sections. So section A deals with the basics of the details of the Indian party and the resident individual. So it basically deals with the Indian party who's making the ODI. And section B deals with the foreign entity in which the ODI is being done. For example, the name, address, the activity code. Activity code is important. Amount of financial commitment being made, the sum total of financial commitment made in that foreign entity, then proposed updated shareholding of the foreign entity after those ODI. So this is also important to be. This is also required to be given in your Form FC. Ki what is the shareholding and what is the shareholding which is after, which will be shareholding percentage after of that foreign entity after this Indian entity has done this ODI, which is okay. Then if there's any step down subsidiary of the foreign entity, you have to give details regarding the same. Section C basically speaks about the nature of investment being made, whether you are doing an ODI in terms of loan, or whether it's an equity share capital, whether it is by a way of guarantee, or whether you're creating any charge or pledge, or you're creating a charge on any foreign assets. So there you have to mention what is the nature of the ODI being made. Section D are the declarations. You have to basically there'll be a lot of declaration, and you have to certify whether you have followed these guidelines. For example, the pricing guidelines, then NOC requirements. We'll talk about NOC requirements also. Then whether the earlier share certificates have been submitted, whether earlier compliances have been done, whether there are any delays in the previous reporting. Very important when you're doing an ODI as a statutory auditor also, you should ensure that any previous reporting, whether there is any delay in regarding the same, if they've not yet been done, you cannot do an ODI before all that delay has been regularized. For example, a company has made an ODI in a foreign entity. He has, and now he wishes to make another ODI. He wishes to maybe invest in more share capital, or he wishes to make a loan. You have to see whether your earlier compliance have been done or not. For example, see, uh, once you have done your first ODI, you have to submit that the company will receive the share certificates from the foreign entity. This share certificates have to be submitted to the AD bank within 6 months of the ODI being done. Okay, or there will be a delay. Then, if once an ODI has been done, as I said, Form APR will have to be filed every year. So if previously in Form ODI has done, and the due date for Form APR has passed by, and Form APR has not been filed, so you have to get it regularized before you are doing another ODI. So always ensure the previous compliances have been done. Now, if a resident individual is making an ODI, we also talk about it in detail, but in short, he can only make an ODI up to the limit of the liberalized remittance scheme, that is USD $250,000 per year. So resident individual cannot make ODI more than that LRS limit per year. So that you should have to ensure. There was a section C. Now, section C is the certificate by the statutory order of the Indian entity, which I am constantly talking, which is a very important part in ODI, and that is the important part which we have a role which we play while doing an ODI. Now, ODI FC Part 2 is an annual performance report. So once a company has done an ODI, every year there's an APR which have to be filed. Currently, the due date is 31st December to file that 31st December of each year to file their APR, and that has to be filed. And we'll discuss in detail later on what all we require to do in Form APR. Form FC Part 3 is the reporting of disinvestment by way of sale or maybe by transfer of shares. So that all reporting goes in Form FC Part 3. As I explained earlier also, what are the compliance with previous remittance we should ensure? First of all, every year till the investment persists, APR has to be filed. Currently, the due date is 31st December. Now, who has to sign this APR? The APR, the annual performance report, it is required to be signed by the management and again certified by the statutory auditor. So again, we play a role over here. And what details does the APR contain? APR contains details of the foreign entity share capital, net worth, and profit and loss. So that is what we are certifying in this APR. The details of the foreign entity share capital, the net worth, and the profit and loss. So it is a must. You should always obtain the audited accounts of the foreign entity, and the audited accounts of foreign entity and the audited account of the Indian entity should be present. And on the basis of that, we can certify the form APR. As I said, the uh, the audited accounts of foreign entity is must if control exists. If the control does not exist, and if they provide unaudited account, that is okay. You can mention that in your API, but that is okay. But if control exists, if the Indian company exercises more than 10% shareholding in the foreign entity will have to get his accounts audited, whether it is applicable in his country or not. He'll have to get his accounts audited in his country only, and he'll have to send the financial audited financial statement to the Indian entity. And Indian entity, again, you have to ensure that whether the board resolution has been passed. See, when we are doing a financials also in Indian entity, when the financials are done on 30th September or whichever period, the board has to adopt these financial statements. So here also the board has to the board of directors of the Indian entity also has to adopt the financial statements of the foreign entity. So this board resolution should also be passed, and that also should be there in our documentation, and that also has to be submitted to the AD bank. Again, the share certificates of the okay, and as I said, the share certificates of the any previous remittance, whenever you're doing an ODI, the share certificate should be received from the foreign entity, and it should be submitted to the AD bank within 6 months. Failing which, you will have to repatriate this money back with if you don't do within the if the you'll get a time limit of more 6 months, and you'll have to repatriate the money back if you're not able to procure the share certificate from the foreign entity and not submit to the bank. You'll have to remit back the money. Then also a form FLA is also required to be filed. Now, form FLA, any company who has received FDI or who has made an ODI, he'll have to file a form FLA. Currently, the due date is 15 July. We'll discuss about it more when we go into the form section. Statutory auditor certificate. Now, what are the basics? As I discussed earlier, what are the basic contents of the statutory auditor certificate? What all things we need to certify and what all things we need to check? Okay. Firstly, we have to certify that the remittance is not in violation of the provisions contained in Rule 19 of the Foreign Exchange Management Rules. Now, this Rule 19 basically deals with the restrictions and prohibitions which have been mentioned in the rule. So, when you're making ODI, this ODI should not be under those categories or under those terms which are restricted or prohibited by the rules. What are the restrictions and prohibitions? We'll just discuss in the next slides. Again, the total financial commitment along with the proposed financial commitment does not exceed 400% of the Indian company's net worth as per the latest available or latest audited financial statements. Then, if you're making an ODI Now, these two are applicable for all type of ODIs, loans, equity capital guarantees. Now, if an Indian entity is making an ODI with respect to equity share capital, then whether the pricing or valuation norms have been complied with. As I said, it has to be at the fair value as per the internationally accepted methodology. So you have to have a valuation report. Valuation report can be signed by a chartered accountant or it can be signed by a merchant banker. So you should have this valuation report and you should see whether it is in line with the valuation report. Now, if ODI is being done in a financial service activity, whether the conditions mentioned in para 2 of the Schedule 1 of the Financial Management Overseas Rules have been complied with. So basically, when you're doing an ODI in financial service activity, there are some limits with respect to you need to have some your net profits within basically one important thing is you need to have net profit in the last 3 years. So there's one of the important conditions to do an ODI in financial service activity. We'll discuss more in later, but when you're doing an ODI, you have to certify that whether it is in compliance with the rules. Then whether Regulation 12 of the Foreign Exchange Management Overseas Investment Regulation 122 has been complied with. Now, what is the Regulation 12? The regulation states that a person resident in India who has previously made a financial commitment in a foreign entity shall not make any further financial commitment directly or indirectly towards such foreign entity or transfer such investment till any delay in reporting of earlier ODI or share certificates are regularized. As I explained, any delay in earlier ODI, we cannot make another ODI to that and for an entity. So you have to ensure you are also certify you have to ensure the same and you are also certifying the same as a statutory auditor. So you, as a statutory auditor, as I said, the standards of auditing with respect to documentation, you should have that form APR, the last APR file, you should have it in your file. You should have, if it FLA is applicable, you should have the FLA form, FLA filed copy, acknowledged copy in your file. Now, form APR is also submitted in hard copy, so you should have that acknowledged hard copy. You should also have the acknowledgement of the share certificate that the Indian entity has submitted to the bank of your previous remittance. So you should have that in your file. Key this, okay, this ODI, this share certificate has been submitted. That acknowledgement bank gives, okay, that they have received, and that copy of that should be there in a file. It is very primary a documentation when you're doing. See, over here we are discussing about ODI. Now, we as chartered accountants, we all know what is a certificate. When you're saying certificate, it is true and correct. Normally, statutory audit we do, it's true and fair. But when certification, we all know it is true and correct. Now, first of all, you are issuing a certificate. It is true and correct. Also, now it is in with respect to FEMA, where RBI is involved, Enforcement Directorate is involved. So all the stakes. We understand the stakes are very high. So our documentation has to be immaculate and our checklist has to be perfect. I'll also be discussing what all checklist we should have to make an ODI. So that should be a prerequisite for signing off the ODI. Without the checklist, without the documentation, you should not sign that ODI. You should have your team working on the same beforehand. So as stakes are high, we have to be on our toes when we are doing the statutory certificate. Now, suppose if a guarantee is being given, now this is also it's also a part. We're just continuing with a part of the statutory certificate only. So, if the remittance is for personal guarantee given, and the guarantee is given by the director or promoter of one of the company of the group company of the Indian entity, then whether the mentioned guarantee together with the financial commitments of the group company are with the limits, the rules and regulation issued by the RBI. So, as I said, a lot of time what happens is an Indian entity, suppose he has made he's made an ODI investment. Now, when he's made an ODI investment, this foreign entity might be having a foreign loan, and that foreign bank might be insisting for a personal guarantee from the director promoter of the holding company, which is the Indian company. So if that guarantee is being given by the Indian promoter or the director for that company, it should be within the limit and it should be within the rules and regulation for the ODI and the guarantee and commitment. So we'll be discussing in detail later on what are the rules and regulations we have to follow when we are making an ODI in financial service activity. What are the ODI or what are the rules and regulations which are required for making a financial commitment and a guarantee. So we'll be discussing it later, but those are the things we need to be taking care. Now, checklist. As I said, what is the checklist and what is the documentation a statutory auditor should have while he's certifying the ODI? Again, see, as I said, the as a statutory certifying this, he's providing a certificate, true and correct certificate with respect to FEMA, where RBI is involved, FEMA is involved, and the money is going outside India. So it is critical because money is going outside India. So the stakes are high, and you should know the latest rules, regulation, and directions when you're certifying the certificate, and documentation has to be perfect. As I said, the statutory auditor should ensure proper documentation as per the auditing standards before signing the certificate. He should obtain the underlying document of the ODI, whether the loan agreement, whether the SPA, share purchase agreement, the guarantee document will be there, guarantee agreement will be there. Then the calculation of the total financial commitment done should be thorough, because there might be a company which may be making a lot of ODIs. We have a client who has made a lot of numerous ODIs in various entities. So it is very important to know the total financial commitment in all the financial foreign entities which he has done. So that calculation has been thorough. Normally, what problems we face is, because see these ODIs, what the company does, it is over a period of time. So normally when we save our folders, we all have a system of saving folders, the system of organizing the files and folders in our office. And normally year wise we arrange the folder. Suppose if you are doing an ODI for 2023-24, it will be in my folder of 2023-24. Then if I'm doing an ODI in 2024-25, it'll be in that year respective folder. So you should and there should be one working file where there should be the track of the last ODI which the company has done. You should not lose the track of the ODI, because you have to calculate total financial commitment up to how till now how much it is, and the include if you add the proposed remittance, it should not exceed 400% of my net worth. So that is a very important condition, and you should always, your folder and file arrangement should be such, you should always have the track of the last ODI which you have signed. Also, when you have an entity who has made a lot of ODI transactions, always ask for the ledgers. Again, look at the latest ledgers of investment, and just cross match your records with them. Any loans, investments, guarantees which you have given, just cross match it with the latest ODIs. Now, see, ledgers, yeah, you will get information about loans, you'll get information about equity share capital, but guarantee sometimes gets skipped out. So you should have a control key last ODI what you have done. Suppose you have done an ODI 2 years ago regarding a guarantee. You should not miss out now after 2 years when you're doing an ODI. You should not miss out considering that amount in your total financial commitment done till date. So very important to have a continuous working file where the latest, you should have a reference number of your latest certificate which you have filed and the date which you have filed, and always cross reference it with the books of accounts again. Normally, if you ask the bank also normally has a portfolio. They also have a portfolio of the ledgers of the transactions you have done in a foreign entity. So you can always ask the client to ask the bank to get that ledger from them, because they also have a listing of the total foreign commitment of a loan, investment, guarantee. So they also have. So you can just ask the client if they can procure it from the bank. So that also you can cross check. Again, the valuation report. The valuation report is critical if you're making an investment under the equity share capital, because the pricing guidelines have to be complied with. Yeah. Now, when you're doing an ODI, you should always ask for the MOA, AOA of the foreign entity, or some document by which you can understand what type of activity is he engaged in. Because if it's in the real estate activity, it's in the financial, there's a restriction if it is in the real estate. There are some restrictions when it is engaged in the real estate activity. Further, if it's in a financial service activity, again, there is a certain other condition which have to be complied with. So you should always ask for any MOA, AOA, or any other document by which you can understand what type of business that the foreign entity is engaged in. Again, as I said, the previous ODI compliances, you should always have acknowledgements of the same. Any submission made to the AD bank, you should always have the acknowledgement of the same. A management representation letter. Again, it's a very critical document. We should always have an MRL before we sign the ODI. The MRL regarding the valuation rate, the interest rate if you're giving a loan. So all these factors should be there in your management representation letter. It should be there. Your audit engagement letter should be there, appointment letter should be there. So these all basic letters, these basic documents should be there. It's a must when you're certifying the statutory certificate. In your certificate, you are allowed to give certain disclaimers, so you should give appropriate disclaimers in your certificate. Though it's a standard format, I think we can give appropriate disclaimers. No, we normally give when we do a certification. When there are a lot of disclaimers we normally give, so we should also give in such a critical certificate. We should also give. Now, there may be certain notes which you may want to give in the certificates. So that also you can bring to light in, if you want to wish to communicate something, you can put it in the notes of accounts. Obviously, this has to be discussed with the client also, the Indian entity also, the bank also, and that it has to be suitably drafted. And as I said earlier, the documentation and the calculation of the 400% of net worth, that should be thorough. One more thing over here is, when you're making an investment, you should also, there's another condition also. If you're making an investment in a foreign entity who is a startup, then you cannot make that ODI you have to make this ODI only from your own capital, and you cannot borrow and invest in a foreign entity who's a startup. So there's also one condition regarding that. So if an Indian entity is investing in a foreign entity, you should take a declaration from that foreign entity whether or not he is a startup or no. You can always understand what is the date of incorporation of the entity. So you get an idea whether it might be a startup or not. But you should on a safer side, you should always get a declaration from the foreign entity whether it's a startup company or not. Valuation, as I said, critical aspect if you're making investment in equity shares. The fair price has to be calculated under the internationally accepted pricing methodology. Now, valuation report can be signed by a chartered accountant or a merchant banker. Now, I've not found this in any rule or regulation, but it is my experiences. If the investment in in a single foreign entity exceeds 5 million USD cumulatively, then generally banks ask for a valuation report of merchant banker. That is what I've seen in my experience. And now then the client also responds. The client has also accepted, and he provides the merchant banker valuation report for that case. So, but that is you have to see it in a single foreign entity. Suppose you made ODI in different foreign entity and it has exceeded $5 million USD. I don't think that should be a problem. But in a single foreign entity, if it exceeds 5 million, cumulatively exceeding 5 million USD, then normally banks ask for a merchant banker valuation. That is, I'll leave it up to. Financial Action Task Force compliance we discussed earlier. It is a global money laundering and terrorist financing watchdog. It sets international standards that aim to prevent these illegal activities and harm the cause to the society. Any Indian entity cannot make an ODI in an overseas entity which is located in a country which is identified by the FATF as a non-cooperative country and territories. There's a website link also I've given. If you just go to the website, and this list should be downloaded and kept as a record, and you should be see that country is not in that list, restricted list. Now, the restriction and prohibitions you should adhere to while you're doing your ODI. First is, um, yeah, if ODI in a foreign entity that a company is investing, or there should not be a structure more than two layers of subsidiaries. So that you have to see that company that is there in the Companies Act. So even in FEMA, if you're doing an ODI and a foreign entity has more than two subsidiaries, so you cannot do an ODI. Or even if you have done an ODI and the foreign entity wishes to make more than two layers of subsidiary, there might be a problem. And as discussed just previously, any ODI in startups by an Indian entity can be made only from internal accruals, whether from the Indian entity or group or associate companies in India. And in case of resident individuals, from own funds of such individuals. So any Indian entity making an ODI in a foreign startup should be from an internal accruals, though it can be done by the internal accrual of group or associate companies. That is okay, but you cannot take a loan, outside loan, and make the ODI. So you should always ask for a declaration of the foreign entity, whether it is a startup or no. And then we know there are some countries in certain jurisdictions where we require prior approval of central government. For example, any entity incorporated or registered in Pakistan or some various other countries. So you require approval of the central government to make the ODI. These restrictions, the above restrictions do not apply to banking companies, NBFC, insurance companies, and government companies. Yeah. Now, FATF we discussed, a company cannot make an ODI in a country, in a company, in a entity which is in a country which is under non-cooperative mode of FATF. Now, one major factor is, if an Indian entity is an NPA. He has taken some loan and now he's become an NPA for that bank, or if he's a willful defaulter, or if he's under investigation by the any investing agency, maybe ED or any other agency. So he before making that ODI, that NOC is a must from the relevant agency. Why? Because see, and in this Indian entity, he has taken a loan from an Indian bank, and he's not repaying this loan. He's become a willful defaulter. He's become an NPA, and he wishes to make an ODI. He cannot repay his own loan, and he wishes to make an ODI. So that should not be permitted unless it is allowed by that respective agency. So an NOC is a must. And again, if we are a statutory auditor, we should ensure this NOC is done. Now, as a statutory auditor, how do we know whether the company is under any investigation by any investigation agency, or whether he's a willful defaulter, or whether he's an NPA? So if there are clear indications, we should go into it. Suppose if we can see, if we know the company has not repaid it, there's a various discrepancies in bank loan repayments. If we know he's not made bank loan repayments for more than a year or so, so we know there might be a problem. Or otherwise, we have to take it on MRL. A management representation letter should be taken. So that should also be done from a statutory auditor. See, once the company sends an NOC to these agencies, if reply is not received within 60 days, then it is deemed it's a deemed NOC. Now, restriction and prohibition to be which are sectors. For example, the real estate sector is restricted. A company cannot make an ODI in a real estate sector. Now, what by real estate sector? What do you mean? Real estate sector means buying and selling of real estate, or trading in TDRs, transferable development rights. See, it does not include development of townships, construction of residential and commercial premises, roads and bridges. So you can do an ODI in a company who is in the development of townships, construction of residential commercial premises. That is okay. But if you're doing an ODI in a company who is trading in real estate or trading in TDR, then there's a restriction. Gambling in any form is prohibited. Dealing in any financial products which are linked to the Indian rupee cannot be done without the specific approval of the RBI. Now, what are certain things to be kept while making an ODI? See, basically, when you're doing your first ODI, you should always consult the client that he should choose his AD bank appropriately. Because once you have chosen an AD bank to do your ODI, it is you have to get the future ODIs done through the same AD bank only. Of course, there might be a requirement of change in bank that can be done, but it requires a lot of formality and a lot of process. You have to ask the bank to transfer the documents to the other AD bank. So it's a big formality procedure which has to be done. So it is always when you're making a first ODI, at that time only you should be clear. You should guide the client. You should be clear which AD bank he wants to designate as his AD bank for making this ODI. Now, foreign currency accounts cannot be opened abroad for making ODI, because no company can open foreign currency accounts abroad and do ODI. Now, if an Indian entity has done an ODI, or now he has sold his ODI, or there's a disinvestment, he should get back the proceeds within 90 days. He should get it collected within 90 days of such receivables. Sure. Now, what happens when there's a delay in reporting? See, you don't want to get into that. Delay in reporting, when we are dealing with FEMA, when we're dealing with RBI, we do not want to get into the delay in reporting. So that should be avoided at the first instance. And that should be put in the client's mind also, okay, whatever happens, there should not be a delay. But still, if there's a delay, what to do? Earlier, FERA and the violations were criminal. Now the violations are more civil. So if there's a delay of up to 3 years, you can pay a late fees, and you can regularize your transactions. The late fees, basically, if you see the calculation, it is basically rupees 7,500 per return for periodical reporting. For example, there's a delay in filing a form FLA, or if there's a delay in filing a form APR, so 7,500 per return. Now, if there's a delay in filing a form for the document for a transactional based form, for example ODI, for example FCTRS, for example FCGPR, then the penalty is rupees 7,500 plus 0.025% of the amount involved into the number of years delay. If the ODI documents have, if the documentation, the ODI documents have not been submitted even after this delay of 3 years, then penal action will be started, and you can go for compounding. once these 3 years have been done. Now, there will be no further ODI allowed to the Indian resident up to the time the delay in the reporting is regularized. So, it's very important to get all the documentation, all the ODI filing done within the time. See, normally when you're doing an ODI, the bank will not remit the money only till you provide the forms to the bank. So that is one important condition. So because you'll file the ODI, you'll sign the form FC. The management will sign the form FC. The statutory auditor will provide the statutory certificate. Then only the ODI will take place. But from APR, from FLA, that you have to take into consideration that. Then suppose if there's an FCTRS or FCGPR, for there the forms have to be filed within 60 days or 30 days of the transaction. So over there may be a delay in that documentation forms. But from ODI, the transaction won't happen only unless you submit a document. Yeah, but the share certificate is not submitted within 6 months, so that can be a delay over there. Now, these ODI rules and regulations which we discussed will not apply to the following. If the purchase or acquisitions, if this ODI has been done out of the purchase or acquisition of funds held in the resident foreign currency account. Suppose it's a saving. What is a residency foreign currency account? It is the if it is an NRI and he is returned back to India and he wishes to hold the foreign currency which he has earned when he was over there, he can keep that in his savings account. He can keep that money in his foreign currency saving account. So you can open a resident foreign currency account and you can do an ODI from there. Or out of the foreign currency reserves held outside India by a person who is employed in India's specific duration irrespective of the length thereof, or for specific job or assignment duration which does not exceed 3 years. Because there is a person who is resident outside India who comes to India and he has held his foreign currency reserves outside India, then he comes under general permission. A person resident in India may hold, own, or transfer foreign securities outside India if such security was acquired by him when he was a resident outside India or inherited from a person resident outside India. So now we just look part by part into the investment in equity share capital, the financial, the loans and the guarantees. A lot of things we've already discussed. So when we have discussed, we'll go a little fast. So if when we're doing investment in equity share capital, the ODI, how all the ODI can be done by subscribing to the share capital, whether listed or unlisted, you can subscribe to the share capital by a bidding or tender process, by acquisition of through rights or by allotment of bonus shares. ODI equity capital can be got. Then there might be a receivable. An Indian entity might have a receivable from a foreign currency which can be capitalized to an investment, but it should be under the rules and regulations, and that entity should also be engaged in the should not be engaged in any activity which is prohibited, and it should not be under any activity which is for which prior permission of central bank or RBI requires. Then there will be a swap of securities. But however, both legs of there's a swap of securities. Both legs of transaction should comply with the FEMA provisions. If there's a merger, demerger, amalgamation, or any scheme of arrangement as per the applicable laws in India or the laws of the host countries. Now, what about rights and bonus shares? A person resident in India who has acquired and continues to hold equity capital in a foreign entity in accordance with the rules and regulations may acquire equity capital through exercise of rights or by way of bonus shares in accordance with the OI rules. Now, how do you go about it? If a company is acquiring shares through rights issue, a form FC will have to be filed, that ODI compliance will have to be done. But if the company is acquiring these shares as a bonus shares, then it will not be considered as a fresh financial commitment, and it will not require reporting because bonus shares has been allotted to him. He's not made any foreign outflow, so it will not require a ODI documentation, and it will not require a financial commitment. But yeah, if you are subscribing to the rights issue, yes, it will be an ODI documentation will be required, and it will be reported in Form FC. Now, however, if he's renouncing these rights in favor of another person resident in India, no reporting. See, we all know the rights issue, you can always renounce the right, and if the rights are renounced in favor of a person resident in India, no reporting. Now, investment in debt instruments. An Indian entity shall not lend directly to its overseas step-down subsidiary. Directly, an entity can lend to its subsidiary, not directly to its overseas step-down subsidiary. Now, a resident individual shall not make financial commitment by way of debt. मतलब a resident individual cannot make an ODI by way of loan. He cannot give a loan ODI. A bona fide document of the loan transaction is a must. An Indian entity may lend, invest in debt instruments issued by foreign entity, subject to the condition that the loans are backed by a loan agreement where the rate of interest will be charged at the arm's length price. Any loan which you are given, which when you are doing in ODI, we should check that the rate of interest should be as per the arm's length price of the existing in the foreign country. Investments can be made in the foreign debt instruments, government bonds, corporate bonds, borrowing. So these debt instruments, ODI can be done. Now, guarantee. Corporate or performance guarantee can be given by an Indian entity to or on behalf of the foreign entity or any of its step-down subsidiary in which the Indian entity has acquired control to the foreign entity. So once there's a control exercised over the step-down over the foreign entity, then only you can give a guarantee. Now, these guarantees cannot be open-ended. It has to be closed guarantee. It cannot be an open-ended guarantee. In case of a performance guarantee, the time specified for completion of the contract shall be treated as the validity period. If a performance guarantee is invoked, the funds need to be and if you're given a performance guarantee and this performance guarantee is invoked, the funds will be you'll have to the guarantee is invoked. You'll have to transfer the funds. That at the time of transfer of funds, you won't require again prior approval of RBI because while making a guarantee only you have gone through the same, if applicable. Now what happens is you have given a guarantee. That time it has become part of the financial commitment you have done. Now the guarantee is invoked. You are making a fund. So see, when you're given the guarantee, though it is part of your financial commitment, you can say it is a part of your non-fund based financial commitment. It will be included in the limit for 400%, but it's a non-fund based financial commitment. Now, when you're transferring the money out of it, it will be considered as a financial commitment by way of debt. But Form FC will have to be filed. So that financial commitment, that non-fund based financial commitment will cease, and your financial commitment by way of debt will take place. Rollover of guarantee shall not be treated as a fresh financial commitment, subject to the end use. See, if there's a guarantee which is being rolled over, so it won't be treated as a fresh financial commitment, subject to end use, and terms and conditions have to be the same. Of course, the validity period will change because rollover is being rolled over, but otherwise the end use and the terms and conditions will be the same. However, when there's a rollover, you have to report in Form FC. Now, guarantee by group company. Now, this gets very interesting. Now, an Indian group company of an Indian entity may extend the guarantee in accordance with the regulations if such group company is eligible to make ODI as per the rules, and such guarantee shall be counted toward the utilization of the financial commitment limit of such group company and shall be reported by the group company concerned. For example, a group company can give a guarantee for its subsidiary or another company, and it can give an ODI for its subsidiary, and that limit will be counted as his financial commitment. Now, definition of a group company, it means two or more enterprise which directly or indirectly are in position to exercise 26% or more voting rights in the other enterprise or appoint more than 50% of the members of the board of directors. No guarantee by the promoter, we've already spoken about it. In case of a foreign entity, which for which an ODI by an Indian we have discussed this. An ODI is done by an Indian entity, and that foreign entity has taken a loan from a foreign bank. The foreign bank may require the resident individual promoter to give a guarantee. So this Indian company can give the guarantee, and it will be counted as his financial commitment with the Indian entity and accordingly reported by the Indian entity who is giving though the promoter is giving the guarantee, it will be counted as the financial commitment of the Indian entity of who is the promoter. Now a case study. Now, A Private Limited, along with B Private Limited, has made ODI in a company in a company in USA, XINC. Now, this XINC wishes to take a loan of 100 crores in USA from a bank in USA. The Indian entities are required to give guarantee individually for this loan. So, how much will the financial commitment be considered for the Indian entity? There are two companies who are giving a 100 crore guarantee to the USA INC company, who is maybe their subsidiary or where they exercise control. So now whether the financial commitment will be considered as 50-50% or 100%. According to me, both companies will have to show as the full commitment. For them, 100 crores will be a financial commitment for both the entities individually. 100 crores each company as a liability, because any company may be asked to repay the liability, and we are jointly and severally liable for the same. So, the limit of 400% when you speaking, the 100 crores limit will be used by both the companies individually and not 50-50%. ODI and the financial service activity. An Indian entity engaged in financial service activity in India may make an ODI in a foreign entity which is directly or indirectly engaged in financial service activity subject to the following conditions. The Indian entity has posted net profits within the preceding 3 financial years. The Indian entity is registered with or regulated by the financial service regulator in India. The Indian entity has obtained approval as may be required from the regulators of such financial service activity, both in India and the host country or host jurisdiction, as the case may be, for engaging in some financial services. So these are the three conditions when we are making an ODI in the financial service activity. Then Indian entity, as we discussed, an Indian entity not engaged in financial service activity can now also make an ODI in a foreign entity engaged in financial service activity. However, which is directly or indirectly engaged in financial except banking and insurance. The main condition is that the Indian entity has posted net profits during the preceding 3 financial years. So basic condition for making an ODI in a financial service activity is it should have posted net profits in the preceding three financial years. And if this ODI is being done by the Indian entity who's already engaged in financial service activity, then it should be registered and regulated by the financial service regulator, and is obtained the prerequisites approvals for practicing in the country or foreign country which is applicable. The ODI by a resident individual. Again, we discussed earlier. Resident individual can only make ODI up to 250,000 USD per financial year under the liberalized remittance scheme. He can acquire equity shares through rights or bonus shares. He can acquire without any limit any foreign securities by way of gift or from inheritance from a person resident in India or person resident outside India who is a relative and who's acquired these foreign securities as per the rules and regulations. This will not form part of the LRS. If he's acquiring the foreign securities by way of gift or inheritance from a person who is resident in India or outside India, and as a relative, it should be a relative. If you're receiving a gift, the person has to be a relative. And if you're receiving as a gift or you're receiving as an inheritance, it will not form part of LRS and your liberalized remittance scheme, and it can be acquired. An ODI, as an individual can acquire sweat equity shares, which you get when you're working for some company. You may get some sweat equity shares, so that you can acquire. Then suppose if you're holding a management post, you may acquire some minimum qualification shares, so that can be done. ESOPs can be received. Any amount receivable can be capitalized to in the form of an investment. However, the terms and conditions have to be satisfied. Swap of securities can be done. ODI in respect of inheritance, see, now one condition is ODI in respect of inheritance, sweat equity shares, acquisition of minimum qualification shares, issued for holding a management post in a foreign entity, acquisition of shares under ESOP may be made in a foreign entity, whether or not such foreign entity is engaged in financial service activity or has subsidiary or step-down subsidiary where the resident individual has control. Now, ODI can also be done by deferred payment. The condition is the person resident in India can acquire shares of a foreign company through purchase by subscribing to a share issue. The payment may be deferred for a definite period of time. There has to be a definite period where the payment has been deferred from the date of agreement. The terms and conditions is the amount of consideration should be considered 400% of the total amount of consideration should be considered for your 400% of net worth. Though you're deferring a payment, you should consider total amount of consideration for your 400% net worth limit. The deferred part of consideration shall be treated as a non-fund based commitment. Full consideration paid should be compliant with the applicable pricing guidelines. And the foreign securities, see, when you're doing a deferred payment, at least the foreign securities equivalent to the amount of the consideration that should be transferred upfront or received upfront to the buyer. At least up to the total, because you see, it's a deferred payment. You've done the investment and you just payment has been deferred. So that a security equivalent to the total amount of consideration you should be transferred upfront from the seller to the buyer. Transfer of liquidation. A person resident in India may transfer investment in equity capital if it is in compliance with the pricing guidelines, documentation, and reporting requirements as per the rules and regulation. He can transfer it to a resident if the latter is eligible to make some investment. You can also transfer to a person resident outside India. But see, if you're transferring any equity share to a person resident outside, Form FCTRs will have to be filed. And valuation, again, valuation will have to be checked. If the transfer is account of mergers, amalgamation, demergers, liquidation of foreign entity, the approval of the competent authority or the host country is required. As we discussed earlier, once a sale has been done or when a disinvestment has been done, this sale proceeds or disinvestment proceeds should be realized within 90 days of such transfer or disinvestment. If the foreign entity is liquidated, it should realize and repatriate back to India within 90 days of the liquidation. Now, when you're making ODI, you should ensure that this investment cannot be done within 1 year. If you have made an ODI and again within 1 year only you want to make a disinvestment, then you have to go maybe for the approval of RBI. However, if it's a case of a merger, demerger, amalgamation, then that is a separate question, but otherwise you cannot. And again, when you're doing a disinvestment also, again, Form FC will have to be filed. So conclusion is, when you're doing an ODI, you have to go through the rules regulation of 2022, ODI directions of 2022, 2024 is also updated, and you should read before you're doing a ODI. The statutory certificate is an important document. Your documentation has to be perfect. Auditing standards should be followed. And the consider when you're doing a consultancy and when you're a statutory, you should always ensure that all the documents have or all the formalities have done without any delay. So we'll go into the important forms filings under FEMA. One is a Form FCTRS, Form FCGPR, Form FC, including Section E certificate, we've already discussed in details. Form DI is Form Direct Investment, Form LLP1 and Form LLP2, Form APR, Annual Performance Report, which we have already discussed, Form FLA, Soft Tax Form, Form 15 CCP. Now, Form FCTRS. What is the full form of the Form FCTRS? Foreign Currency Transfer of Shares. Now, when does it require to be passed? If there is a transfer of shares by a resident, if there's a transfer of shares from a resident entity to a non-resident entity of the shares of a company resident in India, a Form FCTRs will have to be filed. And who will have to file the Form FCTRs? The transferor or the transferee who is resident of India. It has to be filed. The form has to be filed online by the SMS firms portal. It has to be filed within 60 days of the date of remittance or receipt of consideration. And important documents to be enclosed is consent letter is required, consent letter of the transferor and consent letter of the transferee, valuation report, the Form SPA, share transfer forms, declaration from the buyer to the effect that is eligible to acquire these shares. Now, there's a specific Annexure 6 that has been, if you go to the firms portal, you will find this Annexure 6. This is a specific format. You can download it from there. And you require to be that non-resident has to give the certificate. Then you may require a no objection or tax clearance certificate from the chartered accountant. If you're doing if the remittance is going outside India, then if there's a transfer of shares and remittance is going outside India, Form 15 CACB is required. TDS will have to be seen how to go about it. And KYC of non-resident transfer is a must. KYC of the non-resident transferee from his bank, from his foreign bank, that is a must. Then Form FCGPR. Form FCGPR, the full form is Foreign Currency Cross Provisional Return. It is for when an Indian company is issuing shares to issuing shares or any securities to a non-resident investor. Form FCGPR has to be filed. It has to be filed within 30 days from the allotment. It has to be filed at the SMF forms portal. And who is required to file? The Indian company who is issuing this capital instruments to the non-resident non-resident has to file this Form FCGPR. The important documents are valuation report, Form FIRC, because see, money is coming in India. So the Form FIRC becomes a very critical, and it has to be uploaded. When you're filing this Form FCGPR, the FIRC will have to be uploaded. A CS certificate will be required. When you see Form FCGPR, when you see Form LLP1, anytime when FDI is being coming in, you will require a CS certificate whether the company has complied with all the regulations of the Companies Act and as per the FEMA. So this CS certificate will be required. Board resolution of the company who is allotting the shares, that is a must. Copy of the KYC of the non-resident from his bank. See, when you're dealing with a non-resident, the money is coming in India, you require the KYC of the non-resident from his foreign bank. Letter of debit authorization, that means I have received the Indian entity has received the money, so that confirmation should be there, or at least the bank statement of the Indian entity should be there. They have received the money. If FIBB approval is required, then a copy of the approval. Form FC, we have discussed in detail, so I think we'll go forward. We'll go ahead. Form DI. Form DI is basically downstream investments. Now, if there's an Indian entity who has received FDI, and this Indian entity now makes another investment in another Indian entity only. He's making investment in another Indian entity. Now, this subsidiary of this Indian entity, now he has indirectly received foreign investment. He indirectly received FDI. So there's a downstream investment of FDI. So any entity who has received FDI and who's making this downstream investment has to file the form DI. So this form DI has to be filed within 30 days of the date of allotment of equity shares. Again, it has to be filed at the SMF forms portal at the RBI side. SMF forms and the firms portal. FIRMS is the firms portal where you have the SMF forms. Who's required to file? Any Indian entity who has FDI and is making the downstream investment in another Indian entity. Important documents, valuation report of the investee, CS declaration, see FDI is involved, CS declaration is involved. Again, declaration Annexure 6, there's a standard format, we require the declaration. And as I said earlier also, the Department of Promotion of Industrial Trade portal also, there is a separate reporting that you have to do. A lot of time we forget we have to file over there also. So that results in non-compliance. So form DI, if you are doing, remember you have to file at RBI portal, firms portal also go to the DAP IIT portal and file over there also. Then form LLP1. Now, if there's an LLP who has received FDI, he has to file form LLP1. Now, this form LLP1 has to be filed within 30 days of the date of receipt of the consideration. Again, has to be filed at the firms portal. Who is required to file? The Indian LLP or partnership firm who received this, the Indian LLP who has received this FDI. The important documents, valuation report, any ODI, any FCTRS, FCGPR valuation report is a must. Form LLP1, LLP deed will be required. You should see the deed whether it is we can receive FDI, whether any restrictions, consent letters. Then there are certain declarations which you require. Declarations will be required. Also, I have not mentioned over here, but even CS declaration will be required because money is coming in. A CS declaration will be required. Now, if you go to the form LLP1, there are separate annexures, annexure 4, annexure 5. So you should always check whether this money is coming in, is it whether repatriable or non-repatriable. For example, mostly when are they repatriable? If it's coming from a foreign, the money is coming from outside India and it has come from the NRE account. So mostly that will be mostly on a repatriable basis. So so that you should check at a time whether it is repatriable or non-repatriable. Now, form LLP2. Form LLP2 has to be filed when you're repatriating back this the capital of the LLP to the various part with a non-resident partner. Or no, so when there's a disinvestment or transfer of capital contribution or transfer of profit between a resident to a non-resident, form LLP2 has to be filed. Now, the form LP2 again has to be filed within 60 days from the date of receipt, from the date of transfer of funds. Sorry, date of transfer of funds. The onus of reporting shall be on the resident transferee. Again, has to be filed at the SMF forms in the forms portal. And the important documents: LP deed, valuation report, consent letters, standard declarations required. Tax compliance you have to check because money is going outside India. Now, again, as I said, you have to check whether the money which was initially bought in, or whether it was repatriable or non-repatriable. See, if you just go to the rule and regulation of FDI, there'll be an annexure 5 and there'll be an annexure 4. So annexure 4 is non-repatriable basis and annexure 5 is repatriable basis. So if you're falling under annexure 5 repatriable basis, normally when you receive the money, you will get an RBI acknowledgement also. And that RBI acknowledgement also, it will be written whether it is repatriable basis or non-repatriable basis. It will be written. So you should always ensure. Now, if this money which you have received is on a repatriable basis and you're transferring it back, you should directly transfer it to the NRE account of the non-resident person. If you transfer to the NRO, it will be again great pains to transfer to the NRE because there's a lot of documentation will be required. Okay, you might only be able to do it under the $1 million scheme. So if you have money which has come in under a repatriable basis, ensure you transfer it back to the non-resident in his NRE account only and not his NRO account. If you have received this money on a non-repatriable basis, then you can only transfer it to his NRO account and not his NRE account. If you go to the master directions, we just downloaded the master directions of foreign investment in India. There you will see the annexure 4 and annexure 5, and you can go through the same. Form APR, we have already discussed. Form FLA. The Form FLA, basically the full form is Foreign Liabilities and Assets. Who is required to file? Any Indian entity who has either received FDI or is made ODI, he has to file this Form FLA. Right now, that mostly the due date is 15th of July of each year. And basically, there's no document. Now, this Form FLA is uploaded on a separate portal. It's on a FLAIR's portal of the RBI. It's not on the firm's portal. FLAIR, FLAIR. FLAIR portal of the RBI. It's a separate portal. You have to take a separate registration and you have to file a Form FLA over there. No documents need to be submitted, but information has to be put in. Paid up share capital, reserve and surplus, net worth, PBT, PAT, domestic export sales. So they also that these details have to be given. Number of employees on a payroll of Indian entity. Basically, these information, if you see, they basically this foreign asset liability. According to me, this is a form. See, they ask for this form filing in 15 July. Right, that till that time the accounts are also not yet closed of 31st March 24. And you are asking us to provide details of the paid up share, reserve and surplus, net worth. So it is as per the provisional financials. You have to ask the management to prepare the provisional financial statements, and as per the provisional financial statement, you have to fill in the details of the Form FLA. Basically, RBI maybe needs to get the information about the maybe basic FDIs which have taken place, and what are the strengths or what are the strengths or main economic conditions of the company. So that's the information which they want, and maybe they can make important decisions. They can form economic policies according to that, or maybe it may help them in the budget also. So that is what they require the information for. Now, another form which we have seen in experience, which we forget, is a soft text form. Now, there's a software export declaration form. Now, this is a certificate process. It is mandated by the RBI for entities providing export service or providing software related export services. The primary purpose of Softex is to monitor and regulate the foreign exchange transaction associated with software exports from India. See, when you're doing a software export, basically there is not much documentation. When you're sending goods outside India, there's a documentation. You have to pass through the customs. But when you're doing a software exports, basically it is done only through your Wi-Fi. You're done through your internet. So that is what you have to prove. You have done this. See, you have done a software export. You have received money. You have received money from FIRC. You have received money from foreign. So
Marcus,
yes,
really sorry to disturb.
yes.
It's almost 7, so can we proceed to Q&A after the slide, or how much is left?
Actually, can you just give me 5 minutes? I'll just wind up 5 minutes. There's
Sure, sir. No issue, sir. Take your time, sir. Take your time.
I'll
Just
just give me
wanted
five
to
minutes.
just remind you about it.
Yes, sir. So just 5 minutes. I'll just wind it up.
Sure, sir. Thank you so much.
Thanks. Yes. So so the soft text forms, basically that is the documentation. That is what they want to check. Just to ensure that okay, you have provided this software export, you have received this money, and you've done it through the internet. So these are basically the details. Also, they ask the soft text forms. So that you should there's a website. You also have to get yourself registered under the STPI. STPI, there's a who regulates the soft text, and there's a website. You have to go and register over there, and you have to file your returns. The returns have to be filed monthly. There's an annual return also. So those returns have to be filed. The documentation, important documentation is you have to submit your export invoice. You have to submit the FIRC. You have to submit the contract between the Indian exporter and the foreign service receiver. The invoice of the internet service provider also has to be submitted, because that is the only proof that you have used this. You are using the internet to provide the service. So that invoice of the internet service provider also has to be submitted. Now this software form is generated online and it has to be uploaded. It also asks for the number of employees employed by the software company, so that all details are also submitted. So software form also 3 types of forms you have to submit: the SCRF form, MPR form, which is a monthly form, and APR, which is an annual form. So I've given everything in my PPT. You can look into it more in detail. For 15 CACB, though it is with respect to income tax, money is going outside India. So you should always, when money is going outside India, you should always take care of the 15, your TDS compliance should be done, especially when you're doing a form FCTRS. Your 15 CACB should be done. You may also require, a company may require a lower deduction certificate, because we all know when we are making when you're making a purchase of shares, suppose there's a purchase of shares in FCTRS that is being, and a non-resident is selling his shares. So TDS has to be done on the sale value. And if there's some capital, if he has some indexation, or if he has some acquisition cost, then he might have to go to the income tax and ask for lower deduction certificate. He'll have to get so these all important compliances should be done when you're doing an FCTRS. You should always ensure a form 15 CB has to be filed, and what are the TDS rates that you have to do, or whether lower deduction certificate will be required. TAN application will have to be done. So that should be ensured. So basically, I just want to just in small brief, I just want to show how we have to do these form filings. As I said, FLA, we have to, there's another portal, FLAIR portal, Flare portal, that the FLA forms is filed. And other forms, which I said, FCTRS, FCGPR, LLP1, LLP2, these are filed in the firms portal, FIRMS forms portal. Okay. Hard copy forms is form ODI and form APR has to be filed in hard copy. Now, when you're registering under the forms portal, there are two types of registration you have to do. One is an entity user and one is a business user. Now, what's the difference between an entity user and a business user? So, so the Yeah. See, basically, entity user is of the is the login of the entity whose share capital is going to get affected by this transaction. So that will be an entity user, and business user is who has to create a business user. The entity who is responsible for filing this form has to create a business user. So there's separate users login which you have to do. Now, for example, if you're doing an FCTRS transaction, suppose an Indian company is transferring shares of an Indian company to a non-resident company. So Indian company is transferring the shares of an Indian company to a non-resident company. Now, so let's say Indian company A is transferring the shares of a company B to a non-resident company. Okay. So whose entity user will be created and whose business user will be created? So entity user will be created of the company B whose shares are getting transferred. And business user will be created by the entity A who is responsible, who is doing this transaction, who is transferring these shares, and who is responsible for filing this FCTRS. Now, if there's an FCGPR involved, suppose a company is issuing shares or is allotting shares, so whose share capital is getting affected? The companies who's allotting the shares, and who's responsible for filing the form, the company itself. So it will have to create the company A only will have to create the business user also and entity user also. But it will have to be created. These both logins will have to be created. So these logins can be of different companies or it can be of the same company. Form LLP1, FCGPR, the business user and entity user will be of the same company. Basically, it is of the authorized representative of the company. So these logins have to be created. The first an entity user login will be created, and various details we have to be put. There is an authorization letter which has to be submitted. So that authorization letter is also available at the firm's portal. You have to, that authorization letter has to be submitted, and the authorized signatory's PAN card also has to be submitted. So that has to be submitted. And then when you're filing when you're creating a business user, you have to link your entity user. You have to put the SIN number of the Indian entity, and you have to link both the business user and the entity user accounts. Be very when you're when you're registering this company, when you're making this registration, be very ensure the login, the email IDs or mobile numbers which you're using will be valid, because that is a very important thing. Because normally what consultants do, we chartered account consultants normally put their email IDs, but that should be avoided. The client, we should the client should put their email ID, put their contact number, and put those email ID which will be available for existing future also, because the OTPs, all communication will be done at those email IDs. So that will be required. The example which I've given, I just mentioned it over here, but that's the example I've already given. And Flare registration. Flare is a separate type of a registration. It has to be done in the Flare portal for filing form FLA. There also you have to put the authorization letter, and each time you log into the Flare portal, OTP is required. So be very sure which email ID you are putting, because whenever you want to log into the Flare portal, OTP will be required. In Firms portal, only at the time of registration, the OTPs are required, not every time you log in. But Flare portal, every time you log in, OTPs are required. And even if you want to change, suppose you want to change an email ID, it's a cumbersome process. You have to delete the old registration, create a new registration, and then you have to link. Though when you put the SIN number, it's the same SIN number, it will get linked. The old details will come back again. But the process is cumbersome. So ensure you put the correct email ID. Thank you. Thank you for your time. I've exceeded my time. I'm sorry. Thank you. Any questions? I'll just go with the link of the questions. Yes. The first question is, what is the scope of practice for chartered accountant in these segments, and which type of segments, which type of clients to target? See, basically, first, clients to target, very difficult for us to target clients. We should first make a name for ourselves. That is what I understand. We should make a name for ourselves in FEMA. Start looking at your existing clients, whether they require some consultancy. By way of, see, once you are informing your clients about your FEMA violations, any FEMA regulations to be followed with, word of mouth will spread and you will get a good amount of work. For ODI cases, what are the checklist, what are the key issues, and how to audit these transactions? I think I've given in detail the checklist which have to be done by the time of ODI, and the key issues I've discussed. So, can I go further? I'll just go further. Which type of forms are mandatory to be filed by an Indian company in which 99.99% shares are owned by foreign company under FEMA? See, that's been FDI. You have received FDI. When you have received FDI, you have to file. You have every year you have to file your form at the FLAIR portal. FLAIR portal. 15 July is the eternal due date. 15 July each year is the due date. The penalties I've already discussed. What additional? There's a big question. I'll skip this question and go further ahead. What additional technical qualification does a CA have for practicing FEMA? I don't think there's an additional technical qualification required. Basically, it just comes through practice. So once you get one work, you both the model spread and you'll get more work. That basically, and maybe you just have to keep on reading and be ready when opportunity arises. With the valuation as per revenue, I think yes, net worth method is allowed. Net asset value method is allowed. If DCF is not the best choice, net asset value can be done. The meaning of ODI is overseas direct investment. Can we accept money as a gift from unrelated person living outside India? No, gift has to be from a related person. Penalties and consequences of APR I have already discussed. I have received 5 lakhs professional fees for consultancy from overseas client. However, the client is showing salary due to some remedies, limited details. Will it impact any way FEMA or be income tax? Actually, I didn't understand the question. You have received 5 lakh as a professional fees for consultancy from overseas client. The client is showing salary due to some remittance limitations and TDS. Will it impact any way of FEMA? See, if you can justify you have raised an invoice and you can justify if you have an FIRC, if you can justify you have done your service, and then I don't think there should be a problem. Can Indian resident person incorporate a Singapore company and that person will hold 100% of shareholding? A resident individual can do an ODI. I don't think there's a threshold on the percentage you can invest, but you have to go as per the LRS. The Liberalized Remittance Scheme is the only amount you can invest. But the balances of partners' current account will also be considered for net worth calculation related party from. Yes, balances of capital and current account should be considered. Yes. Yes, whether distributed profits lying in the partner's current account can be considered for net worth calculation. Yes, undistributed profit, no, distributed profit. How can be undistributed profits lying in the current account can be considered net worth calculation. When you're distributing the profit you'll be debiting your capital account, so that will go out. What does banking channels mean under ODI regulation directions? Will this banking channel include payment gateway, which is not a traditional bank? No, I think you should go through a normal AD bank. You have to go through a AD bank when you're doing an ODI. Can remittance be made at a later date after the share subscription in foreign entity has been made? Yes, you can enter into see, a lot of times it happens that way only. You do an SPA, you enter into an SPA, and after you enter into an SPA, then you make the remittance. So that can be done. Yes. Can a foreign company in which ODI has been received can buy land or any real estate for investment purpose, and later on after some years it wants to sell the land? See, basically it should not be in the real estate practice. If he has some real estate in which maybe it sells, it does not make it into the real estate field. So if it's not in that field, it does not become a real estate company, then I don't think it should be a problem. Are there any restrictions for a resident individual investing in a foreign entity having Indian wholly owned subsidiary? No, I don't think there should be a problem. Bitcoin, I am not much familiar with. Yeah, how are fees for ODI certifications calculated reasonable? Yes. See, fees for ODI, it requires a lot of work from a chartered accountant, and it is a very critical and crucial part. So you can charge accordingly because it's a must for doing an ODI. So a lot of effort goes into it. So you can charge accordingly. Yes. If UIN is issued on 11 Jan 2024 and the shares have been bought, payment made on 7th December 2023, but the transactions are happening throughout the year, even before the investment or UIN issue, then for the purpose of APR, what is the period to be considered if the following April to March financial year for if they are not? See, this question where it is written ki, a foreign companies accounts cannot be we cannot sign the audited we cannot do the statutory audit of the foreign company. We are not entitled to do that. So if an audit is must of the foreign entity, it has to be got it done from the foreign and or the auditor of that country only. And with respect to UN, first transaction you do, the UN will be automatically generated. So I don't think there should be a problem regarding the same. If shares are bought on 2nd August 2022 and transaction occurring from that time, but UN issued on 12th January 2023, what should be the reporting period in APR? See, if you have bought shares in August 2022, August 122, the financial year which it relates to is 122-23. So APR for 22-23 will have to be filed by December 23. So by December 23, you should have been received an UIN. I mean, that should not be a problem because UIN normally when you do the first transaction, UIN has to be received. So you have to file before 31st December. The points regarding APR filing, I've already discussed. The financial statements, audited financial statements of the foreign entity, the financial statements of the Indian entity, the board resolution is a must for making the APR. For undertaking FCTS filing, is every resident transferee required to create a business user account? Or can the company whose shares are being transferred create the business user and entity compliance on behalf of the shareholder? No, the business user entity user, the entity user has to be created of that entity whose shares are being whose capital is being changed. So that person will create the entity user, and who is responsible for doing the transaction, business user will be created. For remitting of funds from NRO to NRE, yes, normally Part D of 15CA can be done, but normally banks do insist for a 15CA CB. I formed a wholly owned subsidiary, and to subscribe to the shares in the entity, you formed a wholly owned subsidiary. So, but at the time of formation, there won't be a valuation. So, I don't think that should be a requirement. In case of multiple resident Indians investing in ODI, I think everyone should be, according to me, everyone will have to file the APR, according to me. This question is too long, so it's just difficult to understand whether we have to show the investment made by foreign subsidiary of Indian parent company instead. Actually, I'm not getting it right now. When you distribute profit in current account, I don't think when you're distributing the profit, it is debited to your capital account. So capital account will reduce that much. So only undistributed profit should be considered for your net worth calculation. Hello.
Are we done, sir?
Yes, sir. Yes, sir.
All right, sir. Thank you so much for the amazing session.
Yes, sir.
The
Thank you, sir.
participants are more than satisfied with the session, sir.
Thank you,
And
Mr.
I hope to see you again in
Yes,
the
sir.
topic of FEMA.
Thank
Thank
you,
you so
Mr.
much, sir.
Thank you. Thank you, sir.